dollar foreign exchange trade. And I want to bring to your attention pay particular attention as we look for the conditions, the trade conditions, how we identify the trade conditions on multiple time frames. Of course, this is a key for all of our trade strategies, and we particularly emphasize the dual or multiple time frame momentum setups, but we also look at other conditions on both time frames that hopefully all point to the same direction, either a corrective target or a trend target. Plus, in this section, keep careful attention on how we manage the trade in a logical manner. Really, my objective, or at least one of my objectives, is for you to learn how to think and make decisions based on the market conditions. As we get new information, as new bars are added, whether we're looking at weekly bars or daily bars or intraday bars, it provides new information, new market conditions, which we have to make decisions based on whatever the current market conditions are. And of course, what I'm trying to teach you here is how to think and make those decisions. So that's as important as looking at hundreds of different examples, because once you learn how to think and make decisions, then you'll be able to deal with any market condition in any market in any time frame. So let's go on to this next example. This Forex example, I'm going to move through a little bit quicker than I did the S&P example, where we went very slowly through every single detail step by step. But I'll show you how quickly we can look at a market and decide if it's in a position for a trade and the specific trade strategies and trade management. So this is going to be a Forex example with the Euro US dollar. The chart that's showing on your screen is the daily chart of the euro. Through the last bar is April 4th, 2008, just a few days prior to when I've recorded this. And as of the last bar in the chart, we've had a little minor correction down to the 62% retracement, price retracement. Also happens to be, as of that bar of the low, 62% time retracement. I don't show it on the chart because it would kind of muck up the chart, put a little too much on it, but you can see we had 5 bars up, 3 bars down, 62% time retracement. I've got a couple other indicators on the chart that we didn't show in the book, but I just want to show you that you can incorporate other trend following or volatility indicators into the plan just as described in the book. Down below in the indicator window is the DTF, which is called a dynamic trend filter, which is unique in the dynamic trader program, but other software programs have something similar. It's based on what's called adaptive moving averages. And adaptive means that the look-back period is adjusted by a certain scaling factor depending on the most recent volatility. But the point is, it's a trend-following indicator, and it does a pretty good job, better than most simple moving averages. And it's green, which means it's still bullish, which means according to this indicator, the trend is still bullish, and we'd only want to be trading on the long side. The other thing that I've included on the chart is something that most of you are probably aware of, and it's just simply Bollinger Bands or standard deviation bands. And I've used the typical setting, 21 bar look back period, 2 standard deviations of the Bollinger Bands. And we can see that at least for the data shown, and if I had more data, it'd be the same, that they've done a pretty good job of helping to identify both extremes on the upside and corrections on the downside. Where they hit the midline is frequently an area of a corrective low, followed by a continuation of the trend up. And as of the last bar in the chart, this little low is right again at the medium line, which is the midline moving average line for these Bollinger Bands. So there's a couple other indications that say we want to be looking for a long trade. besides just a simple 62% retracement in price and time. And as we see, as of the last bar in the chart, the DT oscillator momentum, which is a combination of stochastic and RSI, has also made a bullish reversal from the oversold zone. So based on momentum and trend following and volatility and price and time, we'd want to be looking for a long trade, for a trade that would probably be long for at least several days. Now, we can use that information for either swing trades that would last several days, or even if we're going to do very short-term trades, we'd still want to be looking on the long side. So let's take a look at the 60-minute data and see where we are as of April 4th, which is the last bar in this daily chart. Well, this is the 60-minute data, and I've got data just for the last few days. Right where my little pointer is, that's April 1st. That was the last bar on the daily chart, and that's the bar when the DT oscillator momentum turned bullish. So as of that time, we'd be interested in long trades, given the probability that the market's going to be sideways to up for several days. Now, as of the 3rd, I just put this data on. That's where we had the 62% time and price retracement on the daily data, and the day that the euro dollar hit the midline of the Bollinger Band's volatility envelope. And I just, I don't want you to get hung up on Elliott wave counts, but it looks like it was an ABC going down into that April 3rd low. And then we came up kind of strongly. We took out that wave B high, which is another bullish indication. And then we've come down through the latter part of April 4th, and I have just the first few bars of April 7th. And as of the first few bars, we've come down to 50% retracement. We've been 25 bars up, 25 bars down. So if this market's making a correction, usually the 100% time retracement is the maximum, and that's what it's at as of the last bar. And as of the last bar, the 60-minute momentum has made a bullish reversal. So everything's in place as of the first few bars on April 7th to consider entry strategies for a long position. All the conditions are in place on the daily and the 60-minute for entry strategies for a long trade that is likely to last for several days. Now, we may trade it just for a few hours. Maybe we're a short-term trader, but in whatever time period trader we are, we only want to look at the long side, and right now is an ideal time to look to enter on the long side with minimum capital exposure. Our entry strategy is going to be one of the two entry strategies we described in the book. We're going to use the trailing 1 bar high in the 60-minute data to enter our 2-unit position. For our exit strategy, we'll bring the stop up, trail it very close to the market following the second 60-minute momentum bearish reversal. And we want to hold on to that longer-term unit until the higher time frame daily momentum has made a bearish reversal. So more than likely, this trade would last, if the trend continues, would last several days, because we've just had a bullish reversal in the higher time frame daily momentum, which would indicate the market should be sideways to up for a few days. And we want to take advantage of that higher time frame trend if it develops as anticipated. So I'm going to set an alert here on the 60-minute data on the 1 bar high, and we'll add bar by bar on and see if we get stopped into the trade on our buy stop on the trailing 1 bar high. I'm going to reduce the amount of data a bit just so we can see the bars a little bit better. So let's add data. Well, there we go. On the next bar, we were stopped into the trade for a 2-unit long position, a tick above the 60-minute 1 bar high. Where's our stop? Well, just right out of the book, right below the low made prior to the smaller time frame momentum bullish reversal. So we're long 156.84 with a stop at 156.24. So we're going to advance the data, and we're going to then look to exit the short-term unit following the second momentum bearish reversal in the 60-minute data. So let's go ahead and advance the data here. Well, as of the last bar shown, we made the first 60-minute momentum bearish reversal. So let's continue to add data. Okay, now as of the last bar, we've made the second 60-minute momentum bearish reversal. So we're going to trail the exit for the exit stop for the short-term unit at the 60-minute 1-bar low. And again, I'm going to put an alert on here, 1-bar low. We'll look to trail it. So we'll get an alert if we get stopped out of this trade. In each 60-minute bar, we'd make an adjustment. And of course, the trading strategies we're dealing with here, we could use on weekly and daily data, or even shorter term data if we wanted to. It doesn't matter the time frame as long as we're using at least 2 time frames. So let's add some more data. So as of that bar, last bar in the chart, we would have been stopped out because we took out the 1-bar low. Stopped out at 157.27. So it would have been a very small profit on the short-term unit, but again, we look to lock in profits on short-term conditions on one unit while we hold the second unit for what we anticipate will be the longer-term trend. And the daily data suggested that we've got at least several days of sideways to uptrend in the euro. And we've only completed about one full 24-hour span since we entered this trade. So let's develop a little strategy here on how we might adjust the stop on our second unit as the market progresses. What would be a logical condition to adjust the stop in the second unit? Well, how about following the next smaller time frame 60-minute momentum bullish reversal? We get a bullish reversal on the smaller time frame, and the market continues up in the direction of the higher time frame momentum and trend, then that would be a good condition to adjust the stop. And I described that in the book, that's one of the types of conditions we look for stop adjustment. So let's add some bars and watch to see if we get the next 60-minute momentum bullish reversal. And not that bar, not that bar. There we got it. As of that bar, we got a 60-minute momentum bullish reversal where the fast line crossed above the slow line. And we could set an alert for that as well to alert us to a momentum bullish reversal and when we adjust the stop. So our stop's going to be adjusted to the low made prior to the smaller time frame momentum bullish reversal, and that would be this low at 156.72. So we brought the stop up considerably closer to the market. Let me clean up the chart a little bit there. And we would have, if we were stopped out at this price, we'd have a very small loss of a few pips on the second unit, which would more than be made up for the small profit we had in the first unit. So let's continue to add bars. And basically what we're looking for now is maybe some market structure along the way and smaller time frame momentum to adjust the stop. But basically we want to hold on to this long position on the second unit until the higher time frame daily momentum makes a bearish reversal. Okay, let's add some more data onto our 60-minute chart. I'm just going to clean it up. We'll take off where we exited the short-term unit and see how the market progresses. See if we need to make any decisions before the daily data makes a momentum bearish reversal. Okay, just wanted to make a note as this last bar started a new trading day because it changed from blue to the gold color. So we've gone through one more complete day. We'll continue to add bars. There, the market's taking off pretty strongly. And there, as of this last bar on the chart, we just started a new trading day. Let's take a look at our daily momentum through, this would be April 9th, and just see where the daily momentum is. So we've switched over to the daily chart, and we have the daily chart is through November 9th. We've had a strong move up. It was a big wide range up day here. But the momentum is still bullish. Daily momentum's bullish, not even in the overbought zone. So we want to keep the stop fairly far from the market and maintain this long trade with anticipation that it probably has another day or two or three of sideways to up movement. So let's go back to the 60-minute data. Do we have a reason, let me just look at the 60-minute data, do we have a reason to adjust the stop on the 60-minute data? Well, we've taken off and done this strong up move, and then we've gone kind of sideways, but we've had a bullish reversal in our 60-minute data from the oversold zone. So that looks like a good logical place to bring that stop up closer to the market. To this swing low made before the bullish momentum on the 60-minute data. So we're going to adjust the stop all the way up here to just below this swing low at 158.11, or excuse me, 158.10. And again, that's even though we're wanting to hold on to this trade, anticipating that the daily momentum still has another day or two or so to go sideways to up. We've had a big up move and a logical place to adjust the stop, not just because it's a swing low, but because we've had the momentum come all the way down to the oversold zone, make a bullish reversal, and that should indicate that on the smaller time frame 60-minute data, the market is likely to be sideways to up for at least several 60-minute bars. So I'm going to add some data on. Came close, but didn't take out that swing low. There we did it. As of the last bar on this chart, on April 10th, we took it out, and we'd be stopped out of that trade at 158.09 that we entered back here about 3 days earlier at 156.83. Again, for a reasonable profit in there. Probably not as much as we might have anticipated, given the higher time frame daily momentum, but we made our decisions in a very logical manner and ended up getting stopped out. Let's see what happens on the daily. Did this market continue higher? We'll add some bars on the daily. Actually, that next day, the daily made a bearish momentum bearish reversal, without the momentum having reached the overbought zone. So we got stopped out based on our 60-minute position, momentum and pattern position, and by the end of that day, it made a bearish momentum. So we didn't get much of an up move, certainly not as much as anticipated, but still we had a profit, at least a small profit on the short-term unit and a pretty reasonable profit on the long-term unit with very minimal capital exposure. You know, there's actually a reason that I wanted to use these conditions in this particular time to illustrate another trade. Let me add some data onto this daily chart. This is the euro going back several weeks. from the time of this trade that we just used in an illustration. I could have gone back and used an example, let's say with the trade beginning in early February, and look at that really strong bull trend that went on for several weeks there. And more than likely, we would have been in a trade for anywhere from several days to several weeks with much higher profit results if I used a period during this strong up move. But unfortunately, every trade we take isn't going to be in the beginning or midst of a really strong trend like we have here. A lot of times it's, and this is just a pretty lethargic little up move. So even though this didn't turn out to be a small or a really strong bull trend like we'd had for the last several weeks, using our analysis that we learned in the book to identify conditions with a high probability, we still had at least a small profit from this trade. And that's what trading's about. Sometimes we're in there and it really takes off and we got a small trend. Sometimes we get stopped out right away and we have a small loss, or sometimes we just get some kind of choppy movement like we did over these last few days in this example. But by using logical trade strategies, identifying the conditions with a high probability and objective entry strategies, and then we manage the trade in a logical manner, we may still come out with at least a small profit on the trade. So it was a really good example of not the ideal outcome, but a good outcome even when the market doesn't take off, and we may still end up with a reasonable profit. The high probability trading strategies approach is applicable to any market conditions, whether it's a strong trending market or a trading range market or a slowly trending market or a counter trend market. The strategies you've learned in the book and on this CD are applicable to any market in any time frame and any conditions. You can never know in advance if a market will be a strong trend or a choppy trading range. You'll never know that in advance. But you do have control to identify conditions with a high probability outcome, as you learned in the book, and how you manage the trade. Again, as you've learned in the book and we've demonstrated in these examples. What you don't have control in is how far or fast the market will trend or not trend following your trade entry. If a market has a strong trend after your trade entry, you have the possibility of making very substantial profits. But if a market doesn't have a strong trend and it's just choppy or sideways, you're either going to get stopped out right away for a relatively small and acceptable loss, or like this Euro example we just took a look at, you're likely the best that's going to be available to you is a relatively small profit, because ultimately your profits are depending on if you're in the market during fairly strong trends. So you can never devise a trading plan that is going to give you a certain profitability. You can devise a trading plan that will take you into the market with minimal capital exposure at periods which have a high probability of the trade being successful, and then it's going to be whether or not the market does or does not have a strong trend once you're in the market is going to determine the potential profit that you can gain from that trend. In this next section, we're going to look at some stock setups, and we're going to begin by doing a dual time frame momentum scan of a portfolio of stocks, which will look at the weekly and daily momentum position for each stock in a portfolio to help us identify potential stock trades. But for any potential dual time frame momentum setup, that's just the first filter to identify a potential trade. Then traders must view the chart and identify the time, price, and pattern position for the potential trade. So we don't make a trade based just on the dual time frame momentum, just as you're taught in the book, is that's a really good filter to identify potential trades. Then we have to look at the individual market to see what position it's in and whether it is a good high probability trade. The menu and setup you see here is